Okay, slide 4. So this is just an example, just to build on the example that we did in the Excel example that we did. So we'll just walk through another example to show you how the deferred adjustment works within the income statement method. So in this example, this example is in the slides, obviously. So the profit before depreciation is 100,000 for the years ended 31st of December 2019 and 2020. On the 1st of January 2019, A Limited purchased equipment for 100,000 and depreciation of 50,000 rand was provided for during 2019 and 2020. Assume that SARS permits a wear and tear allowance of 60,000 and 40,000 for 2019 and 2020. So again, here we see that according to from accounting perspective and from a SARS perspective, both are so both are doing exactly the same thing, but again over here it is the amount that's going to be different, right? Okay, next slide. So again, we're going to have a temporary difference basically. So calculation of our current tax. So our current tax profit before depreciation. So remember, this 100,000 is before depreciation. So that's why we don't add back depreciation, because depreciation was not taken into account when we calculated the 100,000, right? So we just say 100,000. We deduct our wear and tear. So our taxable income is, oh sorry, I'm doing 2020. So for 2020, 100,000 is our profit before depreciation. Wear and tear is 40. 2019 at 60,000. So then our taxable income for 2020 is 60,000. For 2019 it's 40,000. And then obviously we calculate our current tax based on our taxable income at 28%. Alright, so next slide. So let's start in chronological order, right? 2019. So in the statement of profit and loss, we have our profit before depreciation, which is 100,000. We have our depreciation of 50,000, and then our profit before tax is 50,000, right? So then for 2019, if we look over here, our current tax was 11,200. So we have, 11,200. So this is now if we just took current tax into account, right? And we didn't take depreciation into account. I mean, deferred tax into account. So then, so profit before tax is 50,000. Current tax is 11,200. So then we have profit for the period of 38,800. If we go to 2020, profit before tax is again 50,000, because we had profit before depreciation, depreciation of 50,000. So profit before tax again is 50,000. And then for 2020, we calculated our current tax to be 16,800. So current tax here, 16,800, and then we had profit for the period of 33,200. But you guys see over here that in both instances in 2019 and 2020, right, our profit before tax is 50,000 and 50,000. But because of the wear and tear and our calculation of our current tax, our profit now is different, even though the profit before tax is exactly the same. So deferred tax, so again remember, when on our statement of profit and loss, we need to recognize the tax incurred, right? So if we add in our deferred tax, if we add in our deferred tax adjustment, right, our total tax should be the tax that we've incurred on our accounting profits. So our accounting profits is 50,000 in both years. So if we say 50,000 times 28%, that will give us 14,000. So from an accounting perspective, we're saying that we should recognize our taxes that we have incurred. So the taxes we've incurred is 14,000 on our accounting profits. Our current tax, which is calculated based on our which is calculated based on the Income Tax Act, was 11,200 and 16,800 respectively for 2019 and 2020, and our deferred tax adjustment, right? So we have a deferred tax adjustment in order to adjust our current tax to align with our total tax expense, right? Which is the tax incurred on our accounting profit. So our current tax, so our Total tax expense for 2019. So let's just look at 2019. Total tax expense for 2019 is 14,000. The current tax for 2019 is 11,200. Remember, we now want to adjust the 11,200 to 14,000, which is our total tax expense. So what do? We need to increase our tax expense with 2,800, right? And then so then that takes our total tax expense to 14,000 if we do that deferred tax adjustment. For 2020 again, profit before tax is 50,000. Our total tax expense should be 14,000, which is 50,000 times 28% will give us 14,000. Our current tax that we calculated for 2020 was 16,800. And so now what do we want to do? We want to adjust our current tax to align with our total tax expense. So we have 16,800. What do we need to do? We need to decrease our tax expense, right? Remember, I said 16,800. We need to decrease it by 2,800 to get to 14,000. And again, so our deferred tax adjustment is 2,800. All right? And so then, if we look over here now, after we've done the deferred tax adjustment, our profit for the period is 36,000 in both years, right? And so again, as I've mentioned previously, this method that we've done in the Excel sheet, and the one that we've done now is the income statement method. Okay, so based on the example above, the profit for the year without deferred taxation was different, even though the operations of the company did not change, right? In both years, we had a profit before tax of 50,000. So after deferred tax was introduced, the profit for the year was then the same in both years. So the deferred tax, that's deferred some taxation to the following year. So deferred taxation is calculated on temporary differences, right? And so the question that you probably have is like, why do we have deferred tax? Right? So how does it arise? So it arises when items, so when I say items, I mean assets, liabilities, income, and expenses are treated differently by IFRS and the Income Tax Act, right? Tax legislation. And so, and a deferred tax only applies to temporary differences. So remember, we've covered temporary differences in chapter 5 last semester. Temporary differences means that there's some sort of timing issue, and the differences will eventually reverse. So there's differences, but the differences will eventually reverse. Right, and then so we have So then we have two types of deferred tax balances. We have a deferred tax liability. So this means that the amount of income tax is payable in future, right? So it's going to be we have a taxable temporary difference. So it means that we will be taxed in future. So it's a future tax that's going to be payable. And then we have a deferred tax asset, and it is the amount of income tax recoverable in future periods, or we can say it's a deferred tax saving, whatever you want to call it. And it's also known as a deductible temporary difference. So we'll speak about these terms a little bit later as well. So then a deferred tax asset is a debit balance in the deferred tax T account. The deferred tax asset refers to tax which has been charged but not yet incurred. So please have a look at examples 2a and 2b, because it gives a nice illustration of how the deferred tax balance works, deferred tax assets work, and then a credit balance in the deferred tax account is a deferred tax liability, and a deferred tax liability is when the tax has been incurred but not yet charged by the tax authority. So for example, please look at 3a and 3b. Okay, so I think I'm gonna end the slide here, and then, well, in the video here, and I'll continue the slides in the next video.